This is Satya Pradyuman of Cirrus Research. The earnings playbook is just out, and the title of the report is Overly Pessimistic Forecasts Among Cyclicals Fail to Reflect the Stabilizing Profit Cycle. At the heart of this is that over the last 6 months, we have seen forward year estimates begin to stabilize. So if you go back almost a year ago, where you had a record amount of earnings cuts for the forward year, those sort of bottomed out by the summer, and then we started seeing fewer and fewer cuts, and in fact, certain estimates were being revised higher. If we look at this current period, this aggregate chart relates the forward numbers against top line growth for the broader market. And what you'll notice is that the purple curve represents really the top line growth comparisons. Notice the blue line, though, they represent the estimates of forward year. And what this suggests is that it's really rebounded in the last 6-8 months. It is still noisy, but at the heart of it is it seems to be confirming that what we're seeing is a bottoming of the profit cycle. And if this is the case, it does explain quite a bit of where estimates have sort of bottomed and share prices have started to take off, both in the smaller cap arena and especially so in the larger cap arena. So the idea, though, is that as we go into this earnings season, we do think you have certain concerns that are overhanging. So for instance, some of especially the Nifty 7, the technology forecast, is it possible that the prices have gone ahead of where the growth expectations are? That's to be seen. But on the other side, really the remainder of the market, what we're also observing is potentially overly pessimistic estimates. A great example of this is the transports sector. What this relates is really the slowing of top-line growth and the estimates never really recovering, and in fact going even lower. So this really does conflict really with the economic reports we're seeing and all the other evidence of where the economy lies. So as a result, we suspect some of the deep cyclicals may surprise nicely as we go through this season. Nonetheless, the work here on earnings torpedo versus fallen angels becomes more important because we are also in an environment where we have a crowded market. So the Nifty 7, as they report, and in fact this is a crucial week as they report, this becomes a much more important factor in the way share prices move. After all, if we're very focused on 5-7 very, very loved names, any hints of disappointments among those few will ripple through the entire market. So as a result, using earnings torpedoes models to sort of like retain sort of a stable portfolio in a noisier environment is a good thing right now, especially if you're tracking in higher multiple stocks. Take a look at the full report. It's chock full of sector industry comparisons of where the forecast may be too pessimistic or too optimistic. Thank you.